have the most knowledge about the stock market. So she reached out. Anyways, thanks for taking your time. I really hope that I can provide some information about the stock market and what I do in the market. I'm a trader. I've been involved in the markets full-time since 1991. That's when I graduated college. And at that time, I was interested in the stock market. There wasn't nearly as much opportunity or information about the stock market as there is today for you guys. You're really in a fortunate position in that regard, that the opportunity to learn about it is so much easier now. So I mentioned, here's what we're looking at. This is a chart, a stock chart, Apple computer through Friday, the close of business on Friday. What it does is just shows 1 year of trading. You can see it goes from the bottom left to the upper right. That's a good stock. We want it to make these highs are higher and each low is lower. So it's higher highs and higher lows. That's what we call an uptrend. So if it's an uptrend, it means if you own it, you're making money. It's a good stock. If it's in a downtrend and you own it, that's a bad stock. Regardless of what the company is, if you're losing money in it, it's a bad stock. So I had mentioned this last night on Twitter. Twitter's a great community for learning more about the stock market. I said this last night. I said, I'm putting together some of these slides for some group of high school kids tomorrow, and I got a bunch of feedback. Luckiest group of kids ever. Education's a must. Their parents are going to want to take this and stuff. So I hope I can provide you the value. I've been, as I said, I'm a trader. So what that means is I buy and sell stocks each day. A lot of times I do day trading, which means I'll buy it today and I'll sell it by the end of the market close today. Market's open in our time zone from 7:30 a.m. to 2 p.m. Eastern. So, you look at it and you say, wow, what a cool job. Isn't that awesome? You get to buy and sell and make all this money and you can if you're good at it. But I will tell you, it's not easy. It's simple, but it's not easy. Everyone knows, how do you lose weight? Well, you stop eating garbage food and you start doing some exercise. You take in less calories, you burn calories, and you're going to lose weight. It's simple, but is it easy to ignore that donut over there or that box of chocolates or whatever your vice is when it comes to food? It's not always that easy. And it's the same in the stock market because we get emotions involved. There's really, the stock market, there's all the reasons that I'm sure you've heard that, it's a way for companies to raise capital so that they can grow their business. They raise capital by selling stock to the public being you, me, institutions like hedge funds and mutual funds, and they buy those shares, owning a piece of that company and basically betting on the future of that company. They say, hey, I like Apple Computer. I use their products and I think it's a good business. They're growing overseas. Whatever the reasons are, we're in it though for one reason and one reason only, to make money. So if the stock's going down, it's easy for people to justify, well, it's a good company. It'll come back. But what we're happening right now, it's actually a pretty fortunate time in the market for people who are learning, is that we're in a downtrend. The market overall is in a bearish environment. So you hear the words bull and you hear the words bear discussed. The bull market is, market is going up. Bear market is going down. Interesting little tidbit there is where they came up with that is the way that bulls and bears, because it's a battle of supply and demand in the market. They're battling for control of the trend. So a bull, when he fights, he takes his horns and he comes down and hooks up like this. So he charges up to fight. Whereas a bear, he stands on his hind legs, all 1,200 pounds of him. He tries to swat that bull down. So the bear's way of fighting is to push down. The bull is higher. So that's where that came from. A lot of people don't actually know that, which is kind of surprising, I think. But, we're in it to make money. And there's two schools of thought really about how to best approach that. You probably heard of Warren Buffett. Warren Buffett is a true and blue, fundamental analyst. What he does is he looks at the company. He says, what are the sales? What are the earnings? What's going on with the Federal Reserve right now? I don't know if you're talking about this. You must be in your economics class that, the Federal Reserve has kept interest rates very low for a long period of time. On Wednesday, they're expected to raise those interest rates for the first time in about 8 years, I think, in order to combat inflation. inflation, of course, means, inflation right now is 7.9%, highest it's been since 1982. That's why the cost of everything is going up. You see it in the price of groceries. You see it in the price of fuel. You see it in the price of vacations. That whatever it is that you spend money on, the prices are going up. That's inflation. And how does the Fed try to fight that is a different story that I'll let your teacher explain to you. I'm more interested in the fun stuff and how to make money off of all this. So it's, again, about trading. And, when we talk about technical analysis, that's something a lot of people don't understand. It's really about price action. Market moves higher. You can say, why was the market up today? And a lot of times, the people on television will say the market was higher because Facebook said this, or the market was lower because Google did that. And that might be a catalyst that brought buyers or sellers into the market. But the fact is, the markets go up because of simple supply and demand. Supply and demand for the stock. If there's more demand for that stock than there is supply available, then prices will go higher to find that supply. The buyers will say, hey, I want to pay $50 for this morning, but later on in the afternoon, the prices are still going higher and they have a big buy order they have to fill. They're going to keep chasing the prices higher. So it's about supply and demand. Who has control of the trend of whatever stock it is? By the way, if you do have questions, I'll keep my eye on the chat down there, and I'm happy to do that. But I'll allow for some, at the end as well. And hopefully I'll answer your questions as we go along. But again, it's about supply and demand. It's basic as economics gets. What you really want to do to be the best, find the best opportunities are to combine fundamental analysis, which is the business cycle. I'm not going to spend time on this. This is, more textbook type stuff. Again, I'm more interested in this. This is really as basic as you can make. So stocks go through 4 stages of their life cycle, just like the economic cycle does. In the economic cycle, we have a peak that occurs after an expansion. It's easy to say that maybe we're there now because interest rates are just starting to rise. And that leads to bond prices rising, stocks falling. So that's a contraction of the economy. As it contracts, hopefully we can get inflation under control. And then as the market and the economy recovers, we see that new expansion. We see funding for new businesses and that. With stocks, we have the same 4 cycles, but we just call them something a little bit different. When the stocks are going sideways and doing nothing, basically, they're being accumulated by institutions and getting ready for the bullish uptrend. So it's just, stage 1 turns into stage 2. When they're in stage 2, this is bullish. Again, horns go up. The fight is higher. So this is those higher highs and higher lows. Those are the stocks you want to own. And then the market starts to go sideways. And it's kind of uncertain. There's really nothing going on there. And we saw this happen, basically the last 2 to 3 months of last year. And I'll show you a chart of this to make more sense of it in real life terms here towards the end. And then this is the stage the market is in right now. It's in a bearish phase. It's being swatted down. Every time it rallies up, there's sellers waiting, boom, 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 to hit it, and they knock prices down. There's more supply available than there is demand for it. So prices continue lower until enough people perceive a value and it starts to turn sideways and undergoes that accumulation. So buying stocks in a downtrend, I mentioned this to people last night. So one of the things I want to impart to these kids is, number 1, don't buy stocks in downtrends. It's the worst thing you can do is to buy stocks that are going down because the momentum is lower, because smart money, people with information, bigger money is selling. And you might be, let's say your parents are involved in the stock market. Maybe they buy $5,000 worth of stock right here. Well, it's worth $2,000 down here. And they say, sorry, honey, you got to work at the ice cream shop again this summer. I know you didn't want to, but you got to pay for your own school books because I bought that stock because of that stockbroker told me to. Anyways, Apple, let's talk about that one. I figure you guys are maybe juniors or seniors and you were born maybe around 2005. I'm guessing. So if that's the case, if your parents had the foresight to say, I'm going to take $500 and put it Sorry, Sydney, I see you right there. I'm putting in Sydney, an account for Sydney. I'm going to put $500 into Apple Computer, and when she turns 18, I'm going to give that to her. Well, fast forward to today, that stock, Apple, was $1.21 per share. Today, it's 155. That stock went up 12,000% over the course of your life through today. Born in 2002. Well, you probably did even better than Vincent. Maybe my math was off a little bit. 2002, 2003. So maybe I'm thinking junior high there. Anyways, you're a little sister, you're a little brother. Anyways, the point is that $500 is worth $64,000 today. That's pretty exciting. That's what the stock market, that's what we want to find in the stock market. Oh, Sydney does fit the bill. Anyways, born in 2005. So it's worth 64 grand today. That's a poop load of money there. So that's what we're looking for. What we do on this chart, to bring it back to this is a company that I subscribe to. Their service allows me to look at, here are the fundamentals for the stocks. And basically, you might have heard of the PE ratio. That's price to earnings. If you take the price of the stock and divide it by the amount of money that the company made over the last year, so 154 divided by the earnings, whatever they were, I don't know, $1.40 plus $1.30. So let's say about $5 or so. Divided by 5 equals, 26. That's the PE ratio. It's a traditional valuation model. It really isn't that important, and I hope I'm not contradicting anything you've been taught, but I really want to teach you what works in the stock market. Not just all the theoretical stuff. You guys will hear that in college. You'll hear that over and over. But when it comes to trading, we want to own this company, the stocks of companies that maybe we know what the company does. You have an Apple computer. You have, you recognize that their revenues, last quarter went from $123 billion for 3 months versus $111 billion for the 3 months in the same time a year ago. They were up 11%. They're selling so much stuff, and they have these crazy, stupid profit margins. So their earnings were up 25%. So they're squeezing more money out of that. This is the premier stock in the market. What people fall for, though, is, well, actually, let me just go back and explain. I lost the order of my slides here. What we're looking for is, in the stage 1 accumulation, we just want to let them sit there. There's no hurry to buy these stocks. But when they're in uptrends, so we want to buy them as they're rallying. As they start to turn sideways, we want to basically get ready to exit them. Or once they start to break down, let's get out of the stock, because we don't want to lose our profits, because losing profits is an easy thing to do. So as I will give this presentation to your teacher, and if she wants, I will let her, kind of go through this a little bit more in detail about these 4 stages. But, what I'm saying here is the rallies, you look at a stock and you say it's in an uptrend, so you consider it innocent until proven guilty, like our courts. We're innocent until proven guilty. But if it's in a downtrend, it's guilty till proven innocent. You have to wait for the jury to come back with more information to prove to you the buyers are in control and you want to own it. Here's where we are. How many of you have heard of GameStop or saw what happened with GameStop? I'm sure a lot of you have, gone into their store and that sort of thing. In January 2021, GameStop was $20 per share. If you put $500 into it, and these are days, each one of these represents 1 day. 2 weeks later, the stock was $480, and your $500 was worth $12,000. That's what they call buying down here a YOLO trade. You guys know that. I'm not teaching you this. You only live once, right? So these people who, basically become gamblers, they say, hey, you only live once. I'm going to put all of my money into this. It's rocket ships to the moon. It's emoji central. And, the people who buy up here, who buys when it's $300, $350, $400, $450, when it was just $20 2 weeks earlier? Not the brightest group in the bunch, I don't think. They're buying emotionally. You might have heard of FOMO, FOMO is fear of missing out. Everyone else is doing something cool. They're all going to this party this weekend. But my mom said I can't go, so I'm going to figure out how to do it because I got to go to that party because that boy or girl is going to be there and I really want to talk to them or whatever it is. You have this fear of missing out, and it's a real strong motivator for you in your social life. It's a very strong motivator for people who can't control their emotions in the market. Abraham Lincoln said if he had 8 hours a day to chop down a tree, he'd spend 6 of those hours sharpening his axe. In other words, be deliberate, be patient, be prepared, sharpen your axe in whatever you're going to do. Don't just rush through things. Spend the time to make sure you get it right and you make the right decision first. Don't get caught up in, oh man, I should have done that. If I had bought it, even when it was $30, I'd have $10,000 today. Man, I'm just going to buy it here. I can't stand it. Everyone else is buying it. So you get involved, and guess what? That $12,000, you buy it $300, $400, and this is 1 day, 2 days, 3 days, 4 days, 5 days later, it's worth $900. If you spent $10,000, if you invested $10,000, 2 weeks later, if you didn't sell it as it headed down, your rocket crashed hard. You're down 95% of your money in just 2 weeks. So the biggest thing in the market is don't buy stocks in downtrend. Don't look at where they have been in the past and say, hey, it should go back there. It did it before, so it can do it again. This is unusual. This is not normal market behavior for a stock to go from $20 to $450, $480 in the course of 2 weeks. So this is gambling. There's a place for that. I traded some GameStop. I made some money in it. I never held it overnight. So when the day that it closed at 150 and the next day it opened at 280, I didn't own it. But I was okay with not owning it because I knew just as much that it could have opened like it did this day. It closed this day at 350. The next day it opened at 200. To me, I'm not interested in that. I want to make sure I avoid those days. So this is a chart of a company. This is 9 years. So you can see that stage one accumulation took place over the course of 2 years. It had a beautiful uptrend for 2.5 years. And then this distribution in here, it broke down severe stage four. There's a phrase that a lot of people say, which is it takes the escalator up and the elevator shaft down. Just falls completely because of the fear that it's going to zero. The institutions, the biggest money on the planet, they also have the problem of chasing and, needing to lock in their game. So then we undergo that stage one accumulation. And there's a phrase for this as well. I know all these little lingos. I've been doing this 31 years. If they don't scare you out on the way down, they'll often wear you out. So for 2-3 years, the stock did nothing. The people who bought it on the pullback because of FOMO and thought it could go higher again, they wasted 2 years in this stock when there were plenty of other stocks that were going higher. There's no reason to own yesterday's news, basically. So if you look at Facebook, for instance, a company I'm sure you're all familiar with, and I know teenagers don't use Facebook, neither do I. I don't know who does anymore. But the evidence is here that maybe a lot of people aren't using it as much. So this company came public in 2012. So what going public means is that it was a privately owned company. Mark Zuckerberg started it. He got some investors, and the investors seeded his growth. And then they said, listen, we need a whole bunch of money because we want to rule the world with this. And we want to get all the eyeballs, turn into this mega big project. So we're going to sell our stock to the public. We're going to go public. We're going to say we're selling our shares at $42 each to the public, and we're going to raise a ton of money and use that to fund growth for the stock. Well, initially the stock went down. So if you bought 10 shares at $42, you paid $420 for it. Well, guess what? It went down to about $10 per share. So down there, it was worth only $100. But had you held on, just in the middle of last year, summer of last year, it was at $380 per share. Your $420 investment went to $3,800. And that's all good. But if you don't sell on the way down, if you didn't sell it at $340 when it was breaking down, If you didn't sell it at 310 or 300 or 280, now it's only worth $187. Think about the people who bought it, $380 per share. They bought 10 shares, $3,800. 6 months later, it's cut in half. They lost 50% of their money buying a good company. So there's a big difference between a good company and what people perceive to be a good company and what's a good stock. A good stock is one that goes up. This is a bad stock. It's going down. People are losing money. I don't care about the company. That's not my concern. I know that sounds selfish, but that's what the market is. It's a selfish endeavor. We're there to make money, to make our retirement accounts grow, create income so we can make our money work for us. It's a zero-sum game, meaning someone wins, someone loses. Well, if you can get out before it starts going down, you hold on to your money. You have to play a strong defense. You've heard defense wins championships, and it's the same in the stock market. It's easy to make money on the way up, but when it comes down, that's what really separates the successful people in the market. And there's ways to make money on that. You can do something called selling short. Selling short means you don't own it, so you're going to sell it at 330 and buy it back at 200. So you're just doing it in reverse. So it's like buying at 200 and selling at 330, but you sold it first, so you're up 50% on your money. So that's probably a little too technical for this. We're two-thirds of the way through. And people say, buy stocks of companies that you're familiar with. And I'm sure a lot of you are on this Roblox. My nephew told me that, I said, hey, so tell me about this Roblox. I'd never heard of it when it was coming public. They came public in March of last year. I said, it sounds like, a way for kids to, become programmers and make little worlds and stuff. He said, that's what they tell the parents. It's really just a video game where you buy stuff and you can create some stuff, but that's not really what it is. That's the way they sold it to Wall Street, basically. So this one came public at $64.50. So initially, it just went back and forth, up and down, but it went as high as $140 per share. So your $645 investment would have more than doubled just in 8 months. But down here, I know you guys like your emojis, the little puke emoji. Today, it's only worth $394. So you're down. We're feeling good. You bought it because you like the company. You knew you were right. You're so smart. You're patting yourself on the back. Hey, I got this. And then you're down here going, oh, that's okay. It's a good company. It'll come back. And then it starts going down. You're like, wait a minute. What's happening here? Now I'm at break even. This isn't cool. Well, I have another $600. I'm going to put it in there. If you bought more, you're down twice as much. It's in a downtrend. It's a bad stock right now. Don't buy this stock. Wait for, there's no hurry to get involved in these stocks. I know you know PayPal. PayPal has gone from $350 just, let's see, let me pull it up here. PayPal has been one that went from $315 in July of last year, and it's $97 a share right now. Is PayPal a good company? I don't know. I use them. I collect revenues from them, but I certainly don't want to own their stock at $300, and now it's worth $100 today. What if I owned 100 shares of that? I'd be down $2,000. To me, that's just stupid. I'm not there to lose money. It's, trading is a sexy business. It's easy to say, hey, well, how much money can you make? Well, how much money can Steph Curry make? That's like asking, the best people on the planet at their career. Sure, you can make millions. You can make tens of millions. Some of the richest people on this planet run hedge funds. Maybe you've heard of Steve Cohen, who owns the New York Mets. He's a hedge fund manager. He is worth $18 billion just from trading stocks. It's crazy. But you can't say, hey, that's who I'm going to be. It's not normal. You can make money trading stocks, but it's not easy. And you're not going to do it if you hold on to stocks and have beliefs about, hey, it's a good company, I'm going to hold on to it. Why is oil going up right now? A lot of people are going to say, well, because of the war. It's because of Russia. Well, when did Russia invade? Pretty much right over here. Each one of these is 1 week. Now, certainly, oil went from 90 to 130, and it's coming back down. Today it's 102. So it's down a little bit today. But why is the price of gasoline going higher? Is it because the oil companies are greedy and they're just putting, just raising the price of it because they can? Is there a true supply and demand issue? We import 3% our oil in the United States from Russia. It's a very small amount. We're still exporters of oil. A lot of people don't talk about that. So if we stop bringing their oil in, maybe we should just stop letting some of our oil out. The reason that prices go up is because oil is traded like a stock. It's a commodity. You can buy and sell it, and you can bet that it's going to go higher. Well, if enough people start betting that it's going to go higher, it will go higher because nobody wants to sell it to them because we've got a war. So a lot of the market is psychology, trying to understand what are the other participants thinking. Are they thinking that there's going to be a war? If they're thinking there's going to be a war, you want to buy ahead of that. We saw on the news 4 weeks ago that Russia was bringing their tanks in. We saw it when the Olympics were going on, 2-3 weeks before the bombs started dropping. So smart people were buying in here at 90, and when it shot up, there's something called buy the rumor, sell the news. When the news of the war comes out, that's when you want to take your profits and sell it to the people who are, not educated about it and thinking, hey, maybe I should buy oil because of this war. Well, you're buying it from the people who anticipated that. So what we want to do is, again, we want to look at the accumulation stage and say, here's an idea that might make sense. I want to look at this and think about getting long. If I sold it short, I want to buy it back because it's done going down, it looks like. When it goes up, you want to buy it. So go long. You don't want to short it. You're betting on it going down, so you avoid the short. As it goes sideways, you want to exit your long. That means sell the stock that you bought, take your profit, and start to look at it and go, hey, if this thing breaks down, I'm going to sell it short. And then as it does start to break down, you want to sell it short. And right now, there are just so many stocks going down. It's really one of the easiest environments for short selling that I've seen in my 31-year career of trading. It's been great. So this is something that I will also send your teacher, and if you want, I can send a full color copy, 11 by 17, if your students want it. I don't have time, obviously, to go into all this, but this kind of talks about what to look for, how to really understand this. And it goes beyond what we're talking about here. But, a lot of the market, going back to sharpening your axe, a lot of the market is about psychology, anticipating what other people are going to do and trying to position yourself, that is, make a bet before they do. So, for instance, I saw this morning, Tom Brady announced that he's coming back to play for Tampa Bay for another year. He retired 3 weeks ago. Now he's got regrets. He's got FOMO. He's got that fear of missing out on that championship trophy and being the hero again. So he says, I'm coming back. And what happened? Well, if you had bet that the sports betting, if you had bet Tampa Bay was going to be in the Super Bowl next year, you would have paid, I think they said $76 to win 250, something like that, 3 weeks ago. Today, you have to pay, to win that $250, you have to pay $220. So if you had anticipated, hey, I don't believe Brady, I think he's going to come back, you bought it at 76, you can sell it at 220 today. You don't have to wait for the Super Bowl. You can sell into that emotional wave. So there's a principle called the Pareto principle. And if you haven't heard about that, it's basically that, going back to what Abe Lincoln said about sharpening his axe. He's only going to cut wood for 2 of those 8 hours. 6 hours of his day, he's going to sharpen his blade. It's about preparation. It's about being in the zone and being focused. And 20% of your results are going to come from 80% of your preparation. So, and that's true in all walks of life, that, 20% of the people who make the most money, or the people who make their 20% of money are going to combine make more than 80%. It's a proven, look it up, Pareto principle. You can read more about it. How often do you just think about athletes? How much practice do you do when you're playing lacrosse or soccer or track and field or football or field hockey or whatever you're doing? You practice 8 hours a week. Maybe you do stuff on your own. For what? A 1 hour game. All that practice for one result, and you put all your effort into that result. Read Atomic Habits. That's a new book out that talks about maximizing your efficiency, trying to eke out gains in every piece of information that you can have. So before you ever buy a stock, ask yourself, where does it come from? What does that mean? That means if you look at, GameStop, where is it? Up here, where does it come from? Well, it just came from 20 to 200, 300, 400. And where does it have the potential to go before there might be sellers that come into it? So you want to make sure you have what's known as a good risk reward. If you say, okay, if I buy this stock at $30, but it goes down to 27, I'm going to sell it because maybe it goes down to 15, maybe it goes down to, going back to, I guess the best example would have been, maybe Facebook. If you had purchased Facebook up here, there's nothing wrong with buying it at 350. And then it goes to 380. But then if it starts to come down to 340, 330, you got to say enough's enough. I'm cutting my loss here. Because we don't know that this is going to happen, but because it's in a stage 4 decline, it's most likely to happen. And we don't want to be the guy or girl who still owns this stock. You bought it at 330 and you still own it at 187. That's where people look at the market and go, oh, the market's fixed. It's, it's because they don't have a strategy. You have to have a strategy, and the cornerstone of that strategy is called risk management. To make sure you look at it and say, hey, I own a good company. I use their products, and I own it at $1.21. If it goes below 138, maybe I'll sell it because there's nothing to say it might go down to 80 or 40 or 30. Apple has had plenty of 80% declines. Amazon has had 80% declines 12 of its 14 years of being public. 80% declines. If you bought at the peak and put $10,000 into it, you'd have $2,000. Buying a safe stock like Amazon, there's risk everywhere in the market. So learn what that risk reward is. Anticipate. Don't be reactive the way most people do. Look at it and say, here's where I think it's going. The tanks are circling this country. Putin is saying he's not going to do anything, but everything says contrary. If they, oil should go up. So I'm going to buy oil now at 90. And then when it goes up, you don't obviously want to cheer on a war. But if you own oil, you look at it and say, hey, I'm making money. Well, when the price is raised at the pump, I'll have extra money that I made from anticipating this correctly so that I can fill my tank up with no problem, and I have extra money to take a nice vacation or whatever it might be. So those are the keys. This is what I'm kind of known for. I have this phrase called only price pays. And what I mean by that is make sure you learn everything you can about the market from your teacher. They're teaching you the right things. There's a reason they teach you what they teach you about the markets, because it's about how it drives our economy, about how businesses operate. But there's a big difference between the price action of a stock and what a good company or bad company is. So only price pays is kind of what I always remind people. And what that means is you can argue about how good of a company Facebook is, but if you buy it at 300 and you buy more at 280 and more at 260 and more at 250, it's a bad stock because you're losing money. Only price will tell you whether you're right or wrong. You can argue and say, well, it's got this PE ratio and the metaverse is coming and Mark Zuckerberg's a genius. He's well ahead of his time. Great. Let it undergo that accumulation process. It might take 2 years. If Facebook today is at $187 per share, I'd rather buy it at $200 a share in 6 months when it's on its way up than own it today and have the risk that it continues lower. I'd rather buy it at a higher price if it's turning, if this momentum is higher. But when I own it at a higher price, I'll also say, okay, I own it at 200, but if it goes below 194, I'm out. That's it. I'm going to take my loss because it might go down to $50 per share, and I don't want to own that stock. I want to own good stocks. It's a bonus if they're good companies as well, is the way I see it. I know you guys are more TikTok and Instagram and that sort of thing, but if you're on Twitter, I talk about this stuff every single day. CMT, by the way, means Chartered Market Technician. And what that means is that I look at charts and I pass some test that says I'm good at it. A lot of people pass this test and they're not good at it. Again, a lot of doctors, like they say, 50% of the doctors graduated in the the bottom half of their class. Just because you have a degree or a title doesn't mean you're good. You have to go out there and prove yourself in the real world. So I talk about this every single day on Twitter. I've built up a pretty nice following there. And if you're interested more in this, and follow me, and I'll kind of give you a little bit of coaching, whatever. I'd like to open up to any questions right now.
My exact age, because a lady never tells. But I will say, I'm a little embarrassed to admit that I did not know why it was called a bull and bear market. It makes perfect sense. It's exactly the way they fight. I did not know that all these years. So that was kind of interesting.
A lot of people said that on Twitter yesterday. Like, hey, I wish I had that class when I was young. I wish I had that class. It would have saved me so much frustrating times earlier in my career. Like I said, I've been doing this since 1991 full time. And some days I look at it and, how much money can you make everyone wants to know? Well, some days you can lose a lot. You can do the stupidest things and go, what did I do? Who is this person trading my account today? I don't understand it. Human nature it's more about psychology than it is about economics. If I went back to school, to college, and I wanted to be a trader like I am now, I would take basic economics courses and that, but I would be more interested in psychology courses and sociology. What makes crowds act the way they do? How can we anticipate crowd behavior and get in front of that and ride the wave in front of them? It's about anticipating where everyone else will go. It's about anticipating when the bombs drop. Guess what? Stocks are most likely going to go lower because we have all this uncertainty in the world. So like I said, it's been a very good environment for making money selling stocks short. So let me see if we have some questions here.
I was smiling because as you were talking about how psychology is so much more important, I think, Mrs. Einot teaches that class too.
Oh, that's awesome. Good.
Yes. I guess my curiosity would be for any of our young people here, let me back up. What would be your number one tip for them in getting started? Because obviously high schoolers start off with very little in their pocketbook. What would be a good starting spot?
I mean, Robinhood has, is one, but there's also, Ameritrade. You can put in, $50 or $100 and not pay a commission, and you can get access to research, fundamental and technical tools. So, Robinhood's gotten a lot of grief for the way they handled that GameStop situation and that they make money in a kind of secret way. I think that they're great for younger kids. If you got $50, put it in there. You can buy a little bit of Apple and watch it go up and down. Or, when the next YOLO stock comes in, the best way to learn is by doing it. Even though I say I wish I had a class like this when I was younger, I'm the type of person that has to learn things the hard way, unfortunately. And, if you can learn it it might seem like a lot of money if you put $200 in an account and you lose half of it. But if you can learn your lessons, that make that emotional, they still have an emotional connection, but there's still small amounts of money in the grand scheme of things. It might be your entire net worth. It's going to hurt bad, but you have to feel the emotions that go with it. And you have to recognize those emotions and say, when GameStop is at $400 and you're all giddy and you're thinking and you're looking on the internet and you're looking at cars. Hey, I'm going to buy this car and look at that. Now I'm going to upgrade it with these rims and all that stuff. Recognize that behavior. You're getting a little bit emotionally So I would say, Janae, that start with real money in the market, and it doesn't have to be a significant portion of what you have, but just a little piece, and recognize it. Start to look at some charts. You can go to Yahoo Finance. You can go to even TD Ameritrade and Robinhood. They have chart applications where you can see, is it going up? That's a good one. Is it going down? I want nothing to do with it.
See, that is such awesome advice that I couldn't have given them. When I started out in brick and mortar, I taught next to a teacher who taught social studies, but he was very into the stock market. And he encouraged his kids to get into it and help them. And some of them were millionaires by the time they got out of college because of his. So I always feel kind of guilty, and that's
cool?
why I feel it was so important to have someone like you speak. So I appreciate it so much.
So here's Bitcoin. I'm sure a lot of you are talking about the cryptos and, that this is going to be the future and that. But, what's the trend here? This is November of last year. It was at 68,000. Today it's at 38,000. If you bought one Bitcoin, well, you're a rich kid for one because it's $68,000. But today it's only worth $38,000. Is this stock, I just referred to them as stocks, is this a good thing to own right now? It's going down. So it's not a good thing to own right now. If you own it from years ago, then it's good. If you back it up to here in 2016, if your parents bought a Bitcoin for you when you were born in 2003 through 2005, you got $38,000 and they invested, $2, not even. But the point is that there's, it's time frame dependent as well. This is just the last 6 months. And maybe it's starting to undergo that accumulation. But only once it gets above 45,000 and holds above it will we know that it's in a new uptrend, and that would be time to own it. Right now, it's just kind of a waste of time unless you're buying and selling in between ranges, which, there's nothing wrong with that from a trading standpoint, but it's a lot more difficult than it seems. And I would discourage people from day trading. Day trading is like running a marathon. You're not going to see any babies enter in it. A baby has to learn how to crawl first. Then they have to stand up. Then they take their little steps, and then they walk across the room. And then they get older, and they go into junior high school, and they start running track. Around the track, they do a mile, and then, et cetera. It's the progression. That's where you don't want to be. You want to look at it and say, okay, maybe if I buy stocks and hold them for a month or 2 months, I think that's a good time frame because it keeps it exciting, because it should. There's definitely that emotion in there that you want it to be an exciting thing about making money and not doing dumb things like buying things that are going down.
What is maybe an interesting story or a story of impact about one of the biggest mistakes you've seen in the stock market?
My biggest mistake is probably the same mistake that a lot of people make. And it was in 2008. Had a horrific bear market in 2008. And I was trading, actually pretty well. I was making money, every month when the market was going down. And I would make pretty good money, consistently every month. But this guy who sat next to me every day, he would, so the market opens at 7:30 here. He'd roll in at about 9 o'clock every morning. He'd sit down next to me and he goes, hey, what's down the most? So he'd pick XYZ stock. And he'd buy, 2,000, 3,000 shares, and he'd make $5,000, $10,000 in the next 2 hours. Then he'd leave, and I'd be looking at him going, this guy, this isn't supposed to work. So I saw him do this 30 days in a row. And he goes, wait, you're going to do it? Finally? I've got you, I said, sure. I'll buy 500 shares every point that it drops. So I bought 500 shares, and the stock was, let's say, $40. Well, then it went to 39, bought another 500 shares. It went down to 38, I bought another 500 shares. Because this is what he did every day. And he makes $10,000 a day doing this. It went down to 36, down to 35, down to 34, down to 30, went down into the 20s. All of a sudden I had 7,500 shares of this stock, and I was down, I don't know, $16,000 in one day. And fortunately, it wasn't my money. I mean, I still had to make it back. It was for the company I was working for. But, so what happened was I had given into that FOMO. I saw him making money doing something that I thought was dumb every single day, and it got to me. And I finally, of course, that's the way it goes. The day I finally decided to do it was the day it stopped working. I took a huge loss, and I sold it that day, which was a good thing. He held it. He eventually went out of business because of that stock. Crazy. I sold it all that day. I said, I'm done. Forget it. I'm taking my loss. I'll make it back. It's going to take time. FOMO and buying stocks that are going down. If you just don't buy stocks that are going down, you're going to be ahead of 90+% of the people in the market. People that consider themselves professional. It's crazy how much uneducated money is in the market. It's really insane. And just little basic things like don't buy stocks in downtrends. You'll be ahead of so many people, I promise you.
And that is great advice. Thank you.
You're welcome.